Good evening, ladies and gentlemen, and welcome to the MAPS update for Q2 2021. In tonight's session, Ong Ziyang, Portfolio Manager at iFAST Singapore, will be sharing with us about the drivers behind the recent market events, as well as the performance in the past quarter for the MAPS portfolios. We'll also be looking further ahead into the year and sharing about the changes made to the portfolios as we chart a course into the second half of 2021. And with that, I'd like to hand over the time to Ziyang.
Thanks, John. Welcome, ladies and gentlemen. Give me a moment. Let me share my screen. Yep. Thanks. You guys can see my screen, right? Okay. So let me start. First, I'd like to thank you guys for taking the time to join us here today at our quarterly MAPS update webinar. I'm Ziyang, your portfolio manager for MAPS portfolio, and tonight, on behalf of the team, I'll be providing an update on our MAPS portfolio for the second quarter, and more importantly, our outlook for the current quarter, which is the third quarter, and even beyond that. So without much further ado, let's go to the next slide. So for this webinar, there will be 6 parts. First, we'll talk about the second quarter market review and macro drivers. Next, I'll be presenting on the performance of our portfolio over the second quarter. Following that, I'll be sharing our third quarter 2021 outlook and beyond. Next, I'll elaborate on the latest changes. You guys will have noticed it in your when the notification popped out on your app saying that your portfolios were recently rebalanced. So I'll share more details about what has actually gone down within that rebalancing. Next, I'll share our thoughts on the latest top of mind topics. I'm pretty sure a lot of you guys have burning questions, specifically when it comes to the China regulatory environment. Last but not least, I'm going to open the discussion for Q&A, and we'll try to address any of the questions you guys may have for the macros, the market, as well as the MAPS portfolio. So with that, I will now begin with the presentation. So overall, second quarter has been a roller coaster ride of a quarter. We saw the major macro factors converging, like your inflation, reopening, the COVID Delta variant starting to resurge upwards, as well as the sudden fall within the US Treasury. If you can see the chart on the right, at the end of 31st March, it was the peak at 1.74. Since then, I think the Treasury yields just keep dropping, and as of now, it's about 1.15%, which is about 60 basis points, which it dropped as quickly as it rose at the start of the year. So on the positive end, and it's because of a convergence of the confusing mix of a lot of different events. So on the positive end, we saw progress being made towards a post-pandemic normalcy. So a lot of your developed market, like your US and your Europe, were gearing up for reopening. But on the opposite side, especially towards the later part of the second quarter, we saw some of that optimism starting to die down. I think it's also mainly caused by the sudden 4 straight months of inflationary overshoot within the US. And although the Fed started off saying that this is going to be transitory, they slowly start to accept that maybe some of it will not be as transitory as they thought they would be. And in fact, a lot of the market watcher investors start to become a little bit concerned about the hawkish shift in their tone. And of course, within Southeast Asia economies, the outbreak of the more infectious Delta variant, and that has actually hit Singapore as well. We saw over the last 2 weeks, our daily cases has been like 100 over cases. Today it only went back down to double digit, but it also shows that kind of inherent risk that no matter how well vaccinated your population is, this COVID risk is pretty much still very prevalent. And then within China itself, Asia, we saw that the continuation of its regulatory clampdown extending beyond from its tech giants. So your Alibaba, Tencent, your DT, and I think recently the education sector, and now back to Tencent for its gaming. And not just the tech giants, so your property developers were also hit because of the tightening credit situation, which I'll share a little bit more on that topic all the way to the end of the thing of this webinar. So in terms of performance, you can see that nonetheless, second quarter was a really strong month for equity market, specifically for the developed ones. I think performance across the chart are actually within SPE terms. As you can see, MSCI World extended its 6.5 gains in first quarter by 7.6%. So the second quarter actually saw an even better, stronger gain. And this is driven a lot by your developed markets such as the US and Europe. S&P 500 was up 8.7%. Stoxx 600, which is the main index for Europe, is up 7.8%. So for the first half of specifically, they were all up double digit. The EMs were actually not that shabby either. If you look in terms of the quarter, it's up about 5.2%, pulling in close to 9.4%, close to double digit for the first half of 2021. But of course, within the EM itself, it was rather mixed. Asian peers definitely underperformed your Latin America and EMEA peers for the quarter. And the contrast is even more distinct when you actually compare it across the first half of the quarter, the first half of the year. So in general, overall, the value rotation for equities has been which has been dominant for the first 4 to 5 months as the world started to reopen. In fact, that reopening thing, expectations were that US and Europe will lead the reopening, followed by the rest of the world in the second half. But that was now mainly a pipe dream already, with the Delta variant concern kind of sending treasury yields back down, and the tech sector took the spot, the top spot. I think if you look other than the Latin America, the one on the left side, the highest performance was actually digital economy. So given that growth stocks are actually very sensitive to interest rate change, they have high duration, which also means that falling rates will be detrimental for it. Rising rates will be detrimental for it. But on the flip side, falling rates will actually benefit a lot of your tech giants because of their high valuations. And regionally, DM has outperformed their EM counterparts due to the higher vaccination rate, and they actually went ahead to reopen because of the higher vaccination rate, even despite that raging Delta variant. Although there are signs that the variant has been spreading across Europe and US, it has been rather more manageable than Asia itself. More noticeably, of course, our key overweight has underperformed by a good 4 to 5% of the quarter. Only abnormally, of course, Latin America, all the way to the left side of the chart, whose strong performance actually driven mainly by the strong currency gains as they went ahead with monetary tightening in terms of normalizing of its policy, which rising their interest rates and bringing kind of currency upwards for the Latin America and EMEA currencies. So for fixed income, yes, that roller coaster ride is also prevalent, but performance were quite good in second quarter, especially if you compare that to the first quarter, because we saw that reversal within the reversal of the strength of the treasury bond yields. And that has been, while it has been something that was a bane to fixed income existence in the first quarter, it has boosted a lot of your fixed income assets over the second quarter. So if you look further down, you can see that bond markets have generally struck off that inflationary fear, even though we saw 4 straight quarters of CPI hitting about, in fact, May and June was when we saw beyond 5% on year-on-year basis. But in general, I think the bond markets have struck off that inflationary fear, accepting Fed's narrative that the recent resurgence in inflation is a transitory phenomenon. For June's shock, so when it comes to closer to the end of the quarter, June's sharp fall in its yield actually is met with a rally across the bond universe, particularly the high credit sectors. So on the chart on the right, you can see that it's quite clear that investors continue to reach for yields. So they go up, they climb up the credit ladder to the more riskier EM bonds, US high yield for simply because interest rate environment is so low now. So and that actually helped the EM and US high yield to put a very strong showing within this backdrop itself. So moving on to the MAP's performance, we saw that the portfolios actually had quite a decent performance across the quarter, despite the volatility in the markets. Our portfolio generated returns of about 1.8% to 6.3 over the quarter, conservative being the 1.8% one, and the more aggressive one being the 6.3%. Yes, across the quarter versus their respective benchmark, they actually slightly underperform, partly due to our strong overweights to Asia and China, not just on the equity side of things, but also on the fixed income side of things, which have underperformed due to, of course, the idiosyncratic factor relating to China's regulatory environment, something that I would like to share later on in the second half of this presentation. So despite that, so if you look at it in terms of a half-year basis, our conservative to balanced portfolios actually outperformed their respective benchmark, even on an after-fees basis. So this is the results after we have taken off after the management fee. So this is an outcome that we are actually quite happy about. So despite the idiosyncratic factor due to our overweights in China, it gives us confidence that our portfolio construction and positioning ahead will allow us to sort of catch up and possibly outperform, especially if we see a sudden reversal within the pessimism for China and Asian equities. So similar for the income portfolios, performance has been quite similar to your growth portfolios, although a bit of a disparity between the two types if you look at it in terms of a 1 half-year basis, partly due to the inherent nature that income portfolio distribute dividends instead of reinvesting them. But in general, the trend is quite consistent across the first half of the year. Your conservative, moderately conservative, and your balance have actually meet or even exceeded your portfolio respective benchmark performance. So if you look at it in terms of, we break down the first half of the year's performance on a month-on-month basis, you can see that second quarter definitely has done better than the first quarter, and notably in the more aggressive portfolio, partly due to, of course, the risk-on effect across global equity market. All things considered, I think second quarter has been pretty kind to our MAP's portfolio. So yeah, we can take comfort that the asset allocation strategy is definitely still providing value to us, and it's something that moving ahead will still serve us in our interest, even though the odds are against us within the second half of the quarter. Things that also shows the kind of importance for a globally diversified portfolio. So for your income portfolio, we saw the same pattern playing out, where the portfolios actually saw consistent month-on-month gains across April, May, and June. So if you break down the portfolio performance even more, you can see that our developed market fund picks are definitely pulling in the weight for us. For US equities, the Lake Mason Clearbridge US large cap growth has registered a gain of 11.3% versus benchmark of 8.7%, mainly due to that the growth tilt and exposure towards the tech sector. So a lot of your favorite tech names like Amazon, Facebook, Google, if you have been keeping track, their earnings have been off the roof recently. In Europe, we saw similar pattern. The growth-oriented funds, such as your BlackRock Europe Special Situation and the Allianz Europe Growth funds has outperformed the more income-generating ones that is more tilted towards, say, your financials and your more stable value-oriented market, simply due to the growth tilt. So it's a very different situation in second quarter versus the first quarter of the year. And I think in terms of our digital fund pick, which is the OGIC ETF, it continues to pull in weight for us. It's another clear representation that the growth style were the key beneficiary of this drastic fall within the US Treasury yield, which is something of a proxy for risk-free rate, which benefited, of course, your high duration, high valuation assets like your tech stocks. Performance within the EM funds were mixed. I think it's quite clear the Asian funds have peeled in comparison to Latin America and EMEA. A huge extent of that really is the exposure towards China tech, where a lot of these Asia and China fund pick tend to hold favorable or even an overweight position on. But overall, if you look at EMEA and Latin America, our fund picks actually outperform their respective benchmark, which is kind of the silver lining for us, really. So moving on to fixed income funds, most of the funds have actually been in line with their respective benchmark. The Asian-oriented funds, both on IG, such as the Amundi SGD Income Plus and the First State Asian Quality Bonds, and East Spring Asian High Yield has been implicated due to the investors selling off of Asian high yield sector, particularly due to the credit default surrounding the Evergrande Group. But overall, I think they have been quite good picks. I think we are still happy to keep majority of them. Although later I'll share that we have actually made a few switches, specifically 2 switches that were underperforming consistently for the more better outperforming ones. So overall, our tactical ideas continue to add alpha to the portfolios. So special mention, of course, go to the semiconductor sector, which has been a key outperformance for a key performer for our portfolio tactically since our inclusion of the sector in the portfolio last year. If you guys have been following us, you can see that it has been always been one of the top performer. And this year, first half, due to the COVID situation, due to the stay-at-home economy, and of course the supply, the inadequate supply of chips all around the rest of the world, which benefited the semiconductor industry, for the first half is actually up about 22.3%. Another key decision that we are really happy about was what we have actually implemented at the start of the year in our rebalancing, which is the inclusion of global financials. And of course, I'll talk about it. It actually replaced China tech. And it has actually seen pretty good results for the portfolio, up about 17.1% on a first half basis. Fortunate decision, but definitely not something that we actually really forecast, is really the removal of China tech sector as a tactical idea in Jan. Truth be told, we didn't remove it because we anticipated that recent regulatory troubles. The decision mainly stemmed from the fact that we wanted to reduce our overexposure to the sector, which have actually done pretty well by the first half, by January of the year across 2020. And we felt that we already have quite an outsized allocation to the China tech sector via our China as well as Asia fund picks. And this removal of the China tech would then reduce our impact of any possible negative events that unfortunately really materialized for us in the recent regulatory backdrop in the China tech environment. That being said, we are actually closely watching this particular sector at this point of time. So once we deem that valuations and once the situation actually stabilize and valuations are attractive enough that the rewards are worth undertaking the risk, we may actually consider to reintroduce this tactical idea back into the portfolio. So with that, I'll round up the second section, which is the performance of the MAPS portfolio. I'll move on to the second half of this webinar, which is really focusing on the views forward. So I think one easy way to gauge, I'll start off with the macro. So one easy way to gauge where we are in the economic cycle is to look at the global PMI heat map. So for investors who are not familiar with this, PMI stands for Purchasing Manager Index. It's a monthly survey of a diverse range of industry across each economy. And it's commonly used as a leading economic indicators for economies, for portfolio managers, for investors. So glancing across the chart, you can see that things have improved significantly versus last year, the reddish part in the first half of 2020. This chart shows the manufacturing PMI heat map, which shows a broad economic outperformance of the developed market versus the emerging market. Things are definitely a lot more green in the DM versus the EM, and a huge part of that is within the US, Europe, while the UK and Japan definitely is a little bit lagging behind. But if you look at the EM like China, India, Brazil, and Russia, things are definitely not as rosy, which that the manufacturing activity continues to pick up within the DM, which provided them that better outperformance within the first half itself. So moving on to return our focus to the service PMI, you can see that in recent months, service sector within Asia, so your Japan, China, and India were definitely ravaged by the Delta plus surge variant within the region itself. So you see US continue to hit up, although there's a little bit of peaking, you see that it dropped from 70 to about less than 60 by July. And within the developed market, it's starting to slow down, but it's still a far cry versus you see India, which dipped down to 41.2 in terms of the service-oriented PMI. So inflation, so one of the big topic right now really into looking into the investment, into the environment ahead is inflation. Inflation is going to be a big part of the conversation, and I think it will be a part and parcel of investing ahead. So investors needs to be comfortable even if the topic come up time and time again in the news. So if you look at in terms of the core PCI breakdown over the last 2 months, in April and May, can see that we shot up to over 3%, 3.5, and PCI, which is the one that is more headline and more prominent on the newspaper, is around 5 to 5.5%. But I think a good part of it, like the Fed suggested, it's going to be transitory, which is likely going to fade off over the next second to third quarter. So on the chart on the right, if you break down based on base effect, you see that base effect did a low base effect of last year because within the developed market as well as the main part of the world, the COVID situation really became real in the second quarter of the year, from April all the way to June. And the base effect actually accounted for a good 30% to even 50% of the effects from due to the rise in inflation rate. But what we think that inflation, the Fed got a little bit wrong, and they're starting to kind of acknowledge it in their tone, is that inflation could be stickier than expected, and that could threaten Fed's plan of holding off their tapering and monetary tightening policy. So one key part is really the rising home prices within US itself. So for Fed, I think a key metric they look at is not PCI, is the PCE index, which accounts for a huge part of it is actually within the housing related kind of inflation accounts. So you see that that housing related prices due to has actually starting to show up within the housing related inflation. And the second part that really will brings up in terms of inflation impact really is that the huge amount of monetary printing that Fed has done since last year. You can see that in terms of the Fed balance sheet on the right, he has shot up by almost double since at the start of 2020 to this point of time. So the tremendous liquidity injection will inflate the quantity as well as the speed, velocity of money around in circulation, which can actually create a huge spike in terms of the aggregate demand. And ultimately that will actually bring pressure to pressure price level even higher ahead. And I think in terms of a macro perspective, we actually sort of shared this a couple of times, is that in terms of Fed's response to it, which is something that investors are all clearly watching, is that we will actually see a possible reversion in terms of that interest rate in the late 2022. And US seems to be on trend to achieve employment by 2023. So that that will actually push or force Fed's hand to tighten tighten their rates or rate hike as early as 2022. So we actually built two different cases. One is the central case, which we think holds a higher probability, versus the hawkish case, which is sort of the worst case scenario. So any upside, so moving ahead, I think a closely watched matrix will definitely be inflation. If inflation surprise to the upside, and it could possibly, I think, even if you look at in terms of the recent last few months, that the results definitely came way above any economy's expectations. So the kind of surprise could actually catch economies, portfolio managers, analysts by surprise again. And that will may force the Feds to actually bring forward their asset tapering timelines, their rate hike timelines. So and you know how interest rate plays a very big role in determining how, say, your growth assets, your tech giants in terms of your equities and your fixed income. We have seen that if the 10-year treasury yields start to pick up, these are the kind of the strong performers that we have saw in the second quarter will easily become the worst performer within that segment. So we saw a case that both the central case as well as the hawkish case both actually points to a higher US Treasury yields at this point of time. So the sudden fall in the Treasury yields is something that's a little bit out of expectations. It is a little bit due to a combination of tactical factors, as well as, of course, investors thinking that this COVID situation will start to spread across the rest of the world and possibly bring down economic growth prospects. But that being said, we think that investors are underestimating it. The inflation is not going to be just a demand push one. So even if the demand start to die down due to the COVID situation, is also partially due to a supply side thing. So because of your COVID situation, because of the natural disasters that we have been seeing due to the extreme weather condition, such as the floods within Asia and Europe, a lot of this actually caused a lot of supply chain disruptions that has been causing commodity prices, manufacturing costs, and some readjustments required for a lot of shipping delays, a lot of manufacturing delays that can tilt that supply-demand mismatch even further down to an unfavorable factor for prices, pushing prices up. And when inflation were to pick up, the compensation that investors want to account for that rising inflation will actually come to bear, and actually that will push the US Treasury yields even higher ahead. And I think if you invest forward ahead, one key part that investors really are facing at this point of time is that yields in terms of the Treasury. So I think if you look at in terms of TIPS, the Treasury inflation protected securities, that real yields continue to fall further down into negative. So you may think, like, why are investors? So when yields falls into negative, it literally means that investors are paying the bond issuers about 100 basis points for lending them money. But you may think, why would they do that? So what they are doing that is because a lot of investors are paying for safety. When across the rest of the world, where most of the assets are now at near their record high in terms of valuations, and bond yields are now at near their record lows, there's nowhere to go. And the flush amount of liquidity means investors need to find somewhere to stash their cash. And investors are clearly showing that they are paying for safety. They are expecting that uncertainty ahead will be higher. And if you look at on the right, yield curve is starting to flatten again. Investors are losing faith in the kind of growth expectations, a rebound in global growth ahead. Although if you look at it, you look at the yield curve back 1 year ago in June, things definitely. So so when the curve becomes steeper, it means that the future prospects become brighter. So if you compare the current blue line versus the yellow line, it shows that investors, of course, think that the outlook is a lot better. But versus the 31st March, ending 31st March, which is first quarter, I think investors definitely is starting to lose a little bit of faith in terms of the growth prospects. But yet ahead, despite that pessimism, there's, I think, too much cash flushing around in the environment, such that if you look at most equity market, especially the developed market ones, are simply trading at their elevated valuations. You look at US itself, their historical average is around 17.5, and now they're trading at 20.2 PE, and this is forward, so it's based on next year's earnings growth. So even so, it's still trading at about 20 times PE. And we see that the trend consistently across a majority of the global equity market, except the Asian peers one, it was because of the poor performance. They are now a little bit back to their average level, their 5 years average level. And that also shows that there is a little bit of opportunity where if investors at this juncture is looking to enter into the market, especially if you have a more value-oriented approach to looking into things, right now is actually quite a good opportunity for us to kind of adjust our allocation towards the cheaper, less overvalued markets. Then if you look into, and the same trend, you see that within the fixed income sector. So are bonds actually really attractive anymore, with most segment now trading at record low yields? So this is a whole category of 12 different bond yields from your investment grade bonds, high yield across the geographical region, like your US, Europe, EM in Asia. Majority of them you can see are now near their 5 years low, which is also at the same time the record low. And this challenge is really exacerbated by the negative real bond yields, where investors don't have anywhere to go, and they have to reach further into even on the higher credit segment in order to get even a decent, maybe 2 to 3% yields on their portfolios. With the only exception being the Asian high yield segment, which is now, of course, implicated by a lot of the default concern. So that's where we actually see pockets of value emerging. Over the later part of the thing, I'll touch a little bit more on that. So that lopsided performance across the global capital market actually warranted us a mid-year rebalancing. You can look across both the fixed income and equities. You can see that the US, Europe, and more developed market ones, EMEA, versus Asia, which have underperformed, particularly China, that is down 10% as of 31st July, definitely means that a lot of our target allocation are way off. Our current allocation were way off their target already, which also means that if we were to see a sudden reversal within US and Europe developed market, which is now at their expensive valuation, and that there is nowhere for them to seek shelter, we are exposed to even more risk. So as a result of that, because of that first half divergence in terms of performance, it warranted us to do a rebalancing. And as we do our rebalancing, we decided to make a few changes, which I'll move on to the next segment, which is the latest changes we have made in July. You guys have definitely received the notification on it across the last month. I think since the mid of month, I have been rebalancing for across all the MAPS portfolios. And these are some of the changes that we have made. So this is an overview in the July rebalancing. For the fixed income end, I downgraded EM bonds to neutral. I reduced some exposure to the Asian high yield, but of course we still maintain overweight. And by reducing that, I actually move it back to global bonds to move it to neutral. The reason why is because we are positioning for defensiveness within the fixed income segment. In the second half of the year, we think that the market will be a little bit more volatile. There's a lot of uncertainty from the political end all the way to the Fed's response that things could potentially go wrong. And we want to put money where we think things are quality and fundamentally sound. In terms of equity allocation, so at the start of July, that's slightly before what has gone down over the last 1 to 2 weeks. So we managed to slightly avert that kind of decline within Asian and China equities by reducing our Asia exposure to increase our US overweight. But overall, we still maintain an underweight for US. It's just that the underweight should be a little bit more modest, and the overweight on Asia ahead is a little bit more modest as well. So in terms of fund switch, we made 3 fund switch. On the SGD centric one, the Amundi SGD income has underperformed slightly, so for a while already. So it was in our crosshair, and we wanted to move into a more short duration fund because the potential reversal in the rising yield environment means that you want to get exposure to a shorter duration. For global bonds, this is also our first foray, which is a Fidelity Sustainable Strategic Fund. It's our first foray of introducing ESG, the concept of ESG into our portfolio. And over the next few rebalancing, we are actually looking to include more and more ESG orientation, ESG exposure into our portfolio. And we have seen over the last few months and quarters is that ESG does provide a little bit of edge in terms of risk-adjusted returns. For Latin America, we switched from JP Morgan Latin America equities to the Schroders Latin America Fund, which is the better performing one over the long term. And the Schroders Fund is also the recommended funds on our platform. So in terms of, over the next few slides, we're going to talk a little bit more on the changes and the rationale for it. So we did 3 changes for fixed income, downgraded EM, reduced Asia high yield, and maintain overweight, while upgrading global bond back to neutral. So the reason being that is because of the possible rising rate environment. We think that the growth upgrades versus the EMs, particularly with EMs with no, will actually drive sort of a strengthening within the hard currency. But at the same time, I think we think that bonds will actually kind of price in an improving growth outlook via the longer end yields. Although yields fall back to 1.5, 1.15, but we think that a sharp reversal of that in a very, very short term is actually very much possible, leading to a steepening of the yield curve. So as a result, but at the same time, because of rising rates environment within the US itself, this could actually amount to sort of rising credit stress within the EM. So coupled with the earlier tightening of the monetary condition, we think credit stress may materialize right now. Credit stress materializing within China already, but we think that could actually have a domino effect across the EM. So the strengthening US dollar is one of the key factors that will bring about this rising credit stress, given the fact that majority of the EM debt are priced in dollars, which means that strengthening US dollar versus weakening local currency means that the kind of refinancing burdens or financing burdens will become a lot more significant. And for emerging market issuers, particularly those with the shakier balance sheet, will be quite vulnerable to that environment ahead. So given that credit spreads across the fixed income sector, especially within high yields and EM debt, has compressed significantly, we think that the risk-reward prospects are no longer attractive as before. So we opt to reduce our exposure to the risky credit segment and increase our weight to the safer bond segment. And Asia high yield is the only exception where we continue to hold an overweight on. We think that that segment is a little bit undervalued at this point of time, and it definitely offers attractive yield pickup. And at this point of time, it also has a low duration in nature because of its higher return in terms of income returns. So its duration is a bit lower, which also means that it will a rising yield environment will be less affected to the Asian high yield segment versus, say, your other investment grade or more long duration assets. So on the intra-asset allocation for equities, we increased the US by 2.5% and reducing Asia down. So we actually toned down our underweight and overweight heading into the second half. And the rationale for doing that is that during the second half, although right now because of the COVID, because of the Delta variant things, the restart dynamics is a little bit wonky, but overall should follow this order, which is the US first, followed by Europe, Asia, and the rest of the world. So we think that the developed market definitely have the upper hand at this point of time, given that they have the closer access to vaccine supply, while the part of the EM are still fumbling and struggling due to limited access to vaccination. So in view of this backdrop, we opt to narrow our underweight. We think that there is a chance that even though they're expensive right now, they could continue to benefit due to the economic outperformance versus the emerging market. For the EM, valuations are definitely a lot more compelling at this point of time. So therefore, we are comfortable with holding an overweight position on it at this point of time, but things are a little bit uncertain if COVID were to, in the kind of tail risk event where we see COVID going very uncontrollable within Asia and EM, we could see that divergence in performance becoming stronger, and the portfolios may drift further away from the benchmark. So that's something that we don't really want to see. So this is the way we are adjusting our DM versus EM within equity. Can be seen sort of a risk management strategy. And in terms of the risk management strategy, really, it was a focus towards quality in our current backdrop, which also means that the mega cap, your tech companies like your Facebook, Amazon, Netflix, Google, in China side, your Baidu, Alibaba, Tencent, Meituan, these are huge companies with structural tailwinds due to the digital economy environment. So even without COVID, the digital economy is something that we are ushering into. But because of the COVID situation, it's being accelerated and brought forward. And I mean, one key trend is, of course, the remote working trend. And even for me, myself, I'm presenting to you guys from in the comfort of my home. So I'm definitely remote working as well. So this is a trend that it will likely maybe last for all the way to second half of the year or even beyond. And these companies have strong balance sheets and stable cash flow to react to any of this sudden range of negative macroeconomics as well as pandemic outcomes. And also, I think if you look in terms of their earnings, both on China as well as the US tech giant, and they have been blowing estimates off the park. That shows how strong they are and how well positioned they are within this COVID environment. So even if the COVID environment starts to die down, we think that earnings growth will continue to be great because it doesn't mean that we'll stop using Facebook, Google, or stop watching Netflix, even if the rest of the world start to reopen. So these are companies with good, strong structural trend for the long term, and something that we definitely want in our portfolios. And of course, the increased exposure towards US will be through our choice of funds, the Lake Mason ClearBridge large cap growth. You can see within the first few slides, I've talked about that it has actually outperformed significantly. So within EM itself, we prefer Asia, and we still prefer Asia, China, and Latin America over EMEA, which has outperformed significantly in the first half of the year. We reduced our Asia weightage, but we continue to maintain a modest overweight, even more so with the valuations being significantly cheaper, which also means that even if there's more negative news coming out for China and Asia ahead, the kind of negative reaction will be even lesser and lesser due to their cheap valuation. So you will see even if news becomes even worse, the negative implication will be lessened. But yet at the same time, on the opposite, things start to improve, then we'll see an outsized reversal. Everyone's going to switch in their overvalued developed market into Asia again, like what we saw at the start of the year. So in terms of inter-asset allocation, we continue to maintain equity overweight of 5% over fixed income. As you can see that equity has outperformed fixed income significantly, and the fixed income market as a whole is a little bit vulnerable to the rising rate environment ahead. So we are happy to maintain the overweight, but not anymore, because equities are also vulnerable to a lot of the sudden reversion of any political issue, geopolitical factors. We could see a very sharp correction within equity with the fact that equity are quite expensive. But overall, 5% is where we are happy to keep a good balance of. So in terms of the intra-asset location, you can see in terms of from the top down, fixed income segment, majority of them are actually, I neutralize them to neutral already. To make it a little bit more defensive, I reduce weightage to the Asian high yield bonds, but still maintain an overweight. And I think you like to keep US high yield to underweight position, given the fact that credit spreads are now at its record low. So you're getting only about 3% for in use for exposure to US global high yields, when this is something that is you're usually expecting to get around at least a 5 to all the way to 8% kind of returns. Now we are only just getting 3%. It's simply not worth the rewards are simply not worth the risk. On equity side of things, we also neutralize a couple of segments, keeping only modest underweights in the US and Japan, while keeping a modest overweight in Asia, Latin America, and China. Digital economy, yes, we are positive about, but we keep a slight underweight given the fact that valuations are a little bit high, and moving ahead, if the rates were to sudden swing up, a lot of your tech sector may get impacted because of that. So we want to reduce a little bit of exposure towards, we got a little bit of exposure in the tech sector through our China allocation, US allocation. So in terms of digital economy, we want to tone down that risk exposure. So on the overall, you look in terms of positioning for the second half, we really focus on quality, fundamentals, and defensiveness. So we kept a modest overweight on the 4 categories: equity, EM equities, Asia equities, Latin America equity, and Asian high yield, while keeping a lot of more segments to neutral, and underweight some of the more contentious, more expensive sectors that we think rewards are not worth the risk. Last but not least, I think I'll move on to the very last, second last part of this webinar, where really is to address the more touchy topics. So one of the key thing really is the China tech regulations. I think we have received a lot of inquiries from our investors, not just our MAPS investors, but across the platforms about China tech. But here's why we remain positive on the China tech sector. So I think one clear view from China government, really, I think they have been trying to tone down some of their aggressiveness in terms towards the tech giants recently, because they are the key focus in why are they doing those regulations at this point of time is quite clear. They are not trying to freeze the growth of their tech giants, but actually to safeguard consumer interests, ensure the sustainable growth of the sector. The sector is really important for China as an index, as an equity market in terms of healthy growth, and to maintain social stability. Because concerns for the gaming is younger generation spending a little bit too much time on gaming can effectively lower the overall productivity of its economy, of its environment. So there is definitely a lot of check and balances required to tone down some of that, some of the impact caused by the China by the tech environment on our societal structure. So the societal impact of technology on the society. In fact, this is not just isolated within China itself. We've seen that within US as well as Europe. This has been talked since all the way to like 5 to 6 years ago. The Europe and US regulators have been talking about to the tech giants. I mean, it was quite famous, I think, a couple of years ago that Mark Zuckerberg and some of the Google CEO have to go up to the Congress to give for a congressional hearing in terms of the effect of big tech on data privacy, so on and so forth. So the US and European regulators, they also have their sights on trying to tighten their antitrust scrutiny over fixed income. So this is something that is a global issue. Everyone knows that the big tech is here to stay, and they have become a public good, so much so that just like utilities, there needs to be some form of regulation to prevent any misuse of authorities and power. And of course, in terms of power means market pricing power. But China, being a more efficient, I mean, their regulators, they have less, the regulators have more say and kind of more effect in terms of the way they can implement policies across their economy versus US and Europe that is stuck because of a lot of political reasons, a lot of bureaucracy and hierarchy, like through Congress, through Senate, through the whole entire political structure within the developed markets has made it so inefficient that there was a lot of things that they want to implement, but eventually were blocked by opposition, political opposition. But China, we don't have that effect. So China is able to implement any changes they want, up from the way they let their media papers announce the changes, and swiftly within a few weeks, the kind of regulators will be at your doorstep trying to put you into trying to do some corrective action to you. So China sort of leapfrog them in terms of the kind of regulation, in terms of speed, in terms of scope, in terms of severity, in terms for the kind of corrective action they want on their China tech players. But that being said, we think that China tech stocks remains actually quite strategic to China. This is a very, very important segment of their economy because of how it empowers them to in terms of productivity. And yet at the same time, China is now being seen as a strategic competitor to that of the US. And US has been really, really explicit in their challenge for China's rising dominance. And of course, they don't want their homegrown giants to be seen as inferior to with the likes of your Google, Facebook, or a lot of your tech giants coming out from China itself. So as the countries seek to get more greater technological sufficiency, all the way from semiconductors to manufacturing capability to your internet assets, to even in fact your intellectual property, tech giants would definitely be a strategic asset to China. And they don't want to stifle the growth. The growth of China tech industry, which hires a lot of its population and is bringing a lot of standard of living and wealth to its economy, is something that they definitely want to encourage. But precisely that's the reason why they need to regulate, because a lot of big tech were accused of trying to stifle competition using their market pricing power. So it's quite famous within China itself that if you are a startup, you don't go to Alibaba, Tencent, and Baidu. What they will do is they'll just copy your technology and destroy you. So they want to stop that because that destroys innovation, and innovation is the backbone of economy growth for China itself. So they understand that, and what they're trying to do is really to stop the kind of anti-competitive behavior that is partially accused of the China tech player. And the structural growth for China tech as an industry continues to be strong and well. Its internet markets continue to be far from saturated. A huge part of its population still have very, very limited access to internet. And we think that the kind of penetration rate will continue to converge to that of the developed market as standard of living start to increase, and as consumption start to become more and more digitalized. So looking ahead, what to expect ahead? So for the China tech. So while we remain quite positive for the long-term prospects, try to regulate the tech players into and correct them in a way that the regulators are happy about is going to need a little bit of time. So, and at the same time, trying to correct that also means that we won't hear a lot of very positive news coming out from the China tech sector at this point of time. So, with the lack of positive news means you'll just be pessimism all around, and that will mean that the market will probably flounder a little bit, and the kind of regulatory risk within China, inside China sectors, is quite real. I mean, given the fact that the government is able to implement changes and new policies quickly from all the way from planning stage to execution stage with very, very little lag time. And the kind of structural shift in, and they are quite clear that moving ahead, they want to pursue a sustainable rate of growth. Instead of just high numbers, high growth, they want it to sustain. They want everyone to benefit, the growth to be inclusive across the world instead of a wide income disparity of the richest people and the poorer people within, as I say, for example, your US, where you have Jeff Bezos being possibly the first trillionaire versus a huge part of its black community that is very bad standard of living. China don't want to see that. They see that if they continue to let such thing happen, it will happen because they have clear case studies out there within US and Europe. So they want to stop that. So the kind of regulatory focus for China is pretty real, and regulations will be a part and parcel of investing into China ahead. However, I think the short-term volatility at this point of time definitely created a lot of very attractive buying opportunity for at least valuations, especially when you see that earnings growth are picking up quite strongly for, I think, Alibaba. Their latest earnings are above their analyst estimates. And that's across a lot of different China tech companies, simply because they have established that kind of ecosystem where investors who are hooked onto them don't really have an alternative to go to. So you can try to regulate them as much as possible. The inherent strength of these tech giants are just simply too strong, and they have built up the framework for it, which also means that trying to destroy the kind of critical mass effect that they have built up for themselves, it's going to be a little bit difficult and challenging for the regulators. And also, I think it's also key important that not all segments within the tech sectors are affected. I think opportunities remain in sectors that are very, very fundamental to the long-term competitiveness of the country. But more specifically, of course, your artificial intelligence, your semiconductors. So now it's mobile giants are still very, like Huawei, is still quite dependent. I think last year or the year before, it has already reviewed the kind of over dependence or reliance on US technology. And if US were to cut you out cold, your whole development of the economy, of that part of the sector, could essentially come to a stop. And they are well aware of it because of the kind of actions that Trump has done. And so I think it's quite myopic in terms of the US trying to do that, because it means that the Chinese players are trying to find a way to develop it. And if you give them chance to develop it, it's quite clear over the history is that they will develop something that is good and competitive. And most importantly, the price will be significantly cheaper than the same offering provided by developed markets like US and Europe. So with that, I'll also move on to the last topic, that the other hot topic also within China itself for its credit concern. We think that is what's happening to, so a quick roundup about what is happening to the surge in default concerns within China. It started off with the well-publicized credit stress on Huarong Asset Management at the start of the year, which is a sort of a government-linked corporation, and it's deemed too big to fail. But despite the systemic risk that a collapse in Huarong will do to the entire financial system within China itself, the policymakers actually were kind of on the fence to help it. It was almost to the point whereby it's willing to let it fail. And this also means that and this kind of spoke fears within the Asian high yield market all the way from the start of the year. because if something that is government linked, the government board don't even want to help, then less so for the private enterprise like your property developer. If you were to go down, the government definitely will not do anything about it. So right now, the huge fear comes from that. The Asian high yield market is now implicated because of the sell-off in credit property, with concerns surrounding, of course, Evergrande Group spilling over to a lot of other developers with weaker credit. And I think somehow, or rather, a lot of developers, the smaller developers, its recent defaults only serve to prove investors' fear, right? And that has sort of triggered. So your Sichuan Langguang and your China Fortune Land, they have recently defaulted on their debts and it's now going into restructuring talks. That has actually triggered investors' flight to safety. And partially of this low liquidity, this credit stress comes from the fact that China officials, they feel that their economic growth is stable enough for them to turn off the liquidity and credit debts. So this actually leaves the property developer out on the cold to fend off on their own. And they don't want to help because over the last few years, they've been trying to deleverage their economy since all the way from 2012, ever since Xi Jinping took over as the leader for China. They have been trying to tone down a lot of these excesses, but overall they couldn't do it. And I think at this point of time, they feel comfortable. They can go full-fledged to stop such moral hazard and to stop developers from thinking, or a lot of the credit companies that hold a lot of credit to say that, you know what, the governments will bail me out, which what we saw in 2009 and in 2008 in US, and more significantly because of the COVID situation, the Fed actually bailed out a lot of US companies, resulting in a lot of not very competitive zombie companies within the US itself. So fundamentally, despite the current pessimism around, I think a lot of the real estate sector, a vast majority of its developer actually within the safe confines of the 3 red lines guided by the China and policy makers. In fact, I think a good 90% are still within the green to yellow lines. So the truth is, yes, within specific names of your 100 overs of developers, there's going to be bad apples. So and if they start to rot, of course, there is fears that a huge bulk of them will start to rot also. But I think the truth is, it goes to show that it's slightly different at this point of time, because if you get exposure to the whole entire Asia high yield index, the truth is 90% of them are still quite healthy. So at this point of time, we think that Asia high yield is the only segment in the high yield space where we see pockets of value emerging. Its cheap valuation means its high credit spreads at this point of time, and its high income potential is simply too appealing for us to pass up on, especially in this low interest rate environment, and with this low interest rate environment likely to persist slightly longer until Fed decides to do something to inflation, or do investors want to command more sort of compensation for the rising inflation environment. But if not, this low yield environment means that investors will be reaching out to the higher credit segment for income returns. And accumulating some of this high yield bond exposure, especially when it comes to Asian high yield, for our portfolios actually makes sense on a defensive bond, because its low duration characteristics actually offer some degree of defense against upside inflation, as well as rate surprise. But for MAPS, as well as a lot of our investors we have been talking about who invest, DIY investors, is that if you want to get Asian high yield exposure, given the fact that it's so attractive at this point of time, you have to do it through a diversified approach to reduce your risk to single names. So one way to do it is, of course, the recommended fund, which is the East Spring Asian High Yield Bond, and we hedged it to Sing dollar, and it's in our portfolios. As this is the recommended funds, and it's also the fund of choice pick for our portfolios. we think that this active approach will be something that is a way to go for Asian high yield, especially with the fact that we actually know we know the portfolio managers and his experience in the industry in actually sifting out gems and trying to avoid any possible time bomb within the Asian high yield space. So with that, I hope that you guys get a little bit more certainty of what's to come to expect moving ahead. And I hope that I give you guys a bit of reassurance in the sense that we are on top of things and that we are always there to position ourselves to for the future, for the long-term growth, and we set our sights far enough that some form of volatility in the recent juncture should not really affect. We should not respond to every single market noise out there. And I think something that is really heartening to us is that I think once again, our team would like to thank you guys for the kind of loyalty and unwavering support that you guys have given to us, to MAPS the whole entire time, but more specifically during this period of time. I think it's pretty heartening to see that we continue to see very strong inflows on a month-on-month basis into MAPS and barely any withdrawal across the year, despite those huge uncertainty in the market. I think it goes to show that the MAPS investors as a whole, all of us actually really matured as investors to understand that volatility is part and parcel of investing. And also the ability to set the sights far enough to know that portfolios are constructed with a medium-term outlook to outperform in the medium term. So things could be slightly against on our back slightly, but you will and time again, we have shown that we are able to come back from it and rise even further. So our team would really like to thank you guys for your unwavering support you have given to us. And we'd like to reassure you that we are closely watching the market and we'll position our portfolio dynamically to capture any opportunity or to avoid any risk moving ahead.
Thank you so much, Ziyang, this evening for the MAPS update, as well as for sharing in such detail. We also like to thank our audience as well. Thank you all for your kind attention today. And we hope this session has been beneficial for you. So do stay tuned to us at fsm1.com as we continue to bring you more investment ideas and opportunities. So that is all we have for this evening. We wish you all the best. Wish you to stay safe as well, and all the best in your investing journey. Thank you, everyone.
Thank you, guys.